Chapter 21, budgeting. Budgets play an important role for organizations of all sizes and forms. For example, budgets are used in managing the operations of government agencies, churches, hospitals, and other nonprofit organizations. And in this chapter, we're going to describe and illustrate budgeting for a manufacturing corporation or a manufacturing company. Budgeting affects the following managerial functions. It affects planning, directing, and controlling. Planning involves setting goals to guide decisions and help motivate employees. Directing involves decisions and actions. Hey,
I'm sorry to interrupt, but
it's okay.
In like 30, 45 minutes, I have some tech people here.
Okay.
So all this like Wi-Fi and all that stuff about to go out.
Okay. Good thing we're almost done.
Okay. I want to do your morning.
Well, thank you for letting me know that. I did not know that. So we're almost done though, so that's good.
Okay.
Now we have a reason to leave early. All right, so I'm just going to start this whole slide over. Budgeting affects the following managerial functions: planning, directing, and controlling. Planning involves setting goals to guide decisions and help motivate employees. Directing involves decisions and actions to achieve budgeted goals. And within directing, a budgetary unit of a company is called a responsibility center. Each responsibility center is led by a manager who has the authority and responsibility for achieving the center's budgeted goals. Under controlling involves comparing the actual performance against the budgeted goals. Human behavior problems can arise in the budgeting process in the following situations. So budgeted goals could be set too tight or too high or too low. They can just be hard to maintain, or so this can be very hard or even impossible to achieve, which can stress people out. It is important for employees and managers to be involved in the budgeting process together, because a lot of times managers may not see everything that the employee sees, and the employee may not see everything that the manager sees. So working together in this process is something that could be very beneficial to the process and help everyone to attain and create goals that are actually goals that can be reachable. Budgeted goals could be set too loose or very easy to achieve. Such budget padding is called a budgetary slack. And budgeted goals conflict with the objectives of the company and employees. Goal conflict occurs when employees or managers' self-interest is different from what the company's objectives or goals are. The budgetary period for operating activities normally includes the fiscal year of a company. For control purposes, annual budgets are usually subdivided into shorter time periods, such as quarters of the year, months, or weeks. A variation of fiscal year budgeting, called continuous budgeting, maintains a 12-month projection into the future. The 12-month budget is continually revised by replacing the data for the month that was just ended with the budgeted data for the same month in the next year. Developing an annual budget usually begins several months prior to the end of the current year. The responsibility of developing the annual budget is normally assigned to a budget committee, and the budget process is monitored and summarized by the accounting department, which reports to the committee. There are several methods of developing budget estimates. One method is called zero-based budgeting. This requires managers to estimate sales, production, and other operating data as though operations are being started for the first time. And a more common approach is to start with last year's budget and revise it for actual results and expected changes for the coming year. Two major budgets that use this approach are the static budget and the flexible budget. A static budget shows the expected results of a responsibility center for only one activity level. Once the budget has been determined, it is not changed even if the activity changes. Static budgeting is used by many service companies, government entities, and for some functions of manufacturing companies, such as purchasing, engineering, and accounting. A disadvantage of static budgets is that they do not adjust for changes in activity levels. Flexible budgets show the expected results of a responsibility center for several activity levels. A flexible budget is constructed as the following. So step one, we identify the relevant activity levels. The relevant levels of activity could be expressed in units, machine hours, direct labor hours, or some other activity base. Step two, we're going to identify the fixed and variable cost components of the cost being budgeted. And step three, we're going to prepare the budget for each activity level by multiplying the variable cost per unit by the activity level, and then we're going to add the monthly fixed cost. The master budget is an integrated set of operating and financing budgets for a period of time. The operating budgets can be used to prepare a budgeted income statement. The financial budgets provide information for a budgeted balance sheet. Most companies prepare a master budget on a yearly basis. And here we have a diagram. This is showing our operating budgets and financial budgets. And within our operating budgets, we have a sales budget, cost of goods sold budget, selling and administrative expenses budget. And in our cost of goods sold, we could have production budgets, direct materials budgets, direct labor budgets, factory overhead budgets. So you can break your budgets down into, you can have an overall area like the operations, operating budget, but then within that, you could have smaller or mini budgets as well, which is what this is displaying here. Financial budgets, same thing. So they have the financial budgets, but then within that, they've got a cash budget, capital expenditures budget. And our operating budgets are budgeted they're on the budgeted income statement, and our financial budgets are the budgeted balance sheet. The sales budget begins by estimating the quantity of sales. The prior year's sales are often used as a starting point. These sales quantities are then reversed for such factors as planning, so planned advertising and promotions, projected pricing changes, and expected industry and general economic condition. Once sales quantities are estimated, the budgeted sales revenue can be determined as follows. You'll have your budgeted revenue equals your expected sales volume times your expected unit sales price. So however many you expect to sell times the amount of money you expect to sell them for gives you your budgeted revenue. The production budget estimates the number of units to be manufactured to meet budgeted sales and desired inventory levels. The budgeted units to be produced are determined by taking your expected units to be sold plus the desired units in ending inventory minus your estimated units in beginning inventory, and that's going to tell you the total units to be produced. The direct materials purchase budget estimates the quantities of direct materials to be purchased to support the budgeted production and desired inventory levels. So when we look at the direct materials budget, the direct materials purchases budget can be developed in 3 different steps. So first, we're going to determine the budgeted direct materials required for production, which is computed as budgeted production volume times your direct material quantity expected per unit. And then step 2, we're going to take the budgeted material required for production is adjusted for beginning and ending inventories to determine the direct materials to be purchased for each material. So to find the direct material quantity to be purchased, we're going to take the materials that are required for production plus whatever our desired ending materials inventory is minus estimated beginning materials inventory. And that's going to give us our direct material quantity to be purchased. Step 3, the budgeted direct materials to be purchased. We're going to compute that by taking the direct material quantity to be purchased times the unit price. And that's going to tell us what our budgeted direct material to be purchased is. I did fix these. Sorry about that. The direct labor cost budget estimates the direct labor hours and related costs needed to support budgeted production. The direct labor cost budget for each department is determined in 2 steps. So step 1, determine the budgeted direct labor hours required for production. And to find that, we're going to take budgeted production volume times direct labor hours expected per unit. Then in step 2, to determine the total direct labor cost, take direct labor required for production times your hourly rate, and that's going to tell you what your direct labor cost is. Yeah, they said we have about probably 30 minutes.
You need 30 more minutes. Huh? I'll start working on other things until then.
If possible. Yeah. We're supposed to be here till 2. So we're trying to rush through this we just have 1 chapter.
I told them weeks ago, and they agreed to it. But don't worry about it.
We're about halfway through our last chapter.
Okay.
Thank you so much. The pressure. The factory overhead cost budget estimates the cost for each item of factory overhead needed to support budgeted production. The factory overhead cost budget may be supported by departmental schedules. Such schedules normally separate factory overhead costs into fixed and variable costs to better enable department managers to monitor and evaluate their costs during the year. The cost of goods sold budget is prepared by integrating the following budgets: cost of goods sold, direct materials, direct labor, factory overhead. You guys, I think you know that by now. So just add budget to the end. Cost of goods sold budget is prepared by using the direct materials purchase budget, direct labor cost budget, and factory overhead cost budget. The estimated and desired inventories for direct materials, work in process, and finished goods must be integrated into the cost of goods sold budget. The sales budget is often used as the starting point for the selling and administrative expenses budget. The selling and administrative expenses budget is normally supported by departmental schedules. The budget and income statement is prepared by integrating the following budgets. We integrate the sales budget, cost of goods sold budget, and selling and administrative expenses budget into the budgeted income statement. In addition, estimates of other income, other expenses, and income tax are also integrated into the budgeted income statement, and this budget summarizes the budgeted operating activities of the company. The cash budget estimates the expected receipts or inflows and payments, outflows, of cash for a period of time. The primary source of estimated cash receipts is from cash sales and collections on account. In addition, cash receipts may be obtained from plans to issue equity or debt financing, as well as other sources such as interest revenue. To estimate cash receipts from cash sales and collections on account, a schedule of collections from sales is prepared. Estimated cash payments must be budgeted for operating costs and expenses such as manufacturing costs, selling expenses, and administrative expenses. In addition, estimated cash payments may be planned for capital expenditures, dividends, interest payments, or long-term debt payments. To estimate cash payments for manufacturing costs, a schedule of payments for manufacturing costs is prepared. The cash budget is structured for a budget period. This is an example. So we have our estimated cash receipts minus the estimated cash payments, which gives us our cash increase or decrease. If it's negative, it'll be a decrease. Then we're going to add in our cash balance at the beginning of the month to get our cash balance at the end of the month. This then becomes the beginning balance for the next period. So when you're thinking of January to February, January 31st, whatever the balance is the ending balance. At January 31st at 11:59 p.m., that's the ending balance. Next day, February 1st, it would then convert over to the beginning balance for February. So the ending balance for January, beginning balance for February. So we have our cash balance at the end of the month minus whatever the minimum cash balance is. That's going to give us the either excess or cash deficiency that we have. If it's negative, then we have a deficiency. The capital expenditures budget summarizes plans for acquiring fixed assets. Such expenditures are necessary as machinery and other fixed assets wear out or become obsolete. In addition, purchasing additional fixed assets may be necessary to meet increasing demand for the company's product. Capital expenditure budgets are often prepared for 5 to 10 years into the future. So you normally have a 5-year budget or a 10-year budget when looking at capital expenditures. And this is necessary because fixed assets often must be ordered years in advance. The budgeted balance sheet is prepared based on the operating and financial budgets of the master budget. The budgeted balance sheet is dated as of the end of the budget period and is similar to a normal balance sheet, except that estimated amounts are used. Practice problems. This did not update. Okay, so I took this out of the PowerPoint because it's part of a question. We don't have the whole question here, so I'm going to skip this. Apparently it did not, I didn't save the updated one. So Jace Manufacturing, yes. So this will be our first practice problem. Jace Manufacturing Company's static budget for 10,000 units of production includes 40,000 for direct labor and 4,000 for variable electric power. Our total fixed costs are 24,000. At 12,000 units of production, a flexible budget would show. For the sake of time and power, I'm going to go ahead and show you, go through the answer with you guys. So we have our direct labor. We've got the 12,000 units at $4 per unit gives us 48,000. And our electric power 12,000 units at 4 cents per unit gives us 4,800, which gives us a total variable cost of $52,800, and our total fixed cost is $24,000. And it shows you here how we computed the 4 and the 0.4. We took our 40,000 for direct labor and divided that by 10,000 units to figure out $4 per unit for direct labor. For the electric power, we took the 4,000 variable electric power, divided that by the 10,000 units of production, and that gave us our 0.4 per unit. So that's how we were able to calculate the direct labor and the electric power, because we had to first figure out the per unit amount and then multiply that to find that direct labor and electric power. So total variable cost 52,800. The answer to this one was C, which is number 3. And so this is variable cost of $52,800, and then the fixed cost were $24,000. If budgeted beginning inventory is 8,000, budgeted ending inventory is 9,400, and budgeted cost of goods sold is 10,260, budgeted production should be. Close. So we're going to take our budgeted ending inventory of 9,400. We're going to add in the budgeted cost of goods sold of 10,260, and that's going to give us a total of that 19,000. But then we have to subtract out our beginning inventory, our budgeted beginning inventory of 8,000. So the answer is going to be 3C, 11,660. At the beginning of the period, the cutting department budgeted direct labor of 155,000, direct materials of 165,000, and fixed factory overhead of 15,000 for 9,000 hours of production. The department actually completed 10,000 hours of production. What is the appropriate total budget for the department, assuming it uses flexible budgeting? So the answer for this one is B, 370,556. We're going to take the direct labor, this 10,000 hours of production, times the 17.22 per hour, add in our direct material, 10,000 times 1833 per hour, and that's going to give us our total variable cost. Ugh, I can't write, that's a 5. $9,000. That's the direct labor of 155,000 divided by the 9,000 hours of production. And this is the 165 divided by the 9,000. That's how they came up with those numbers. At the beginning of the period, the assembly department budgeted direct labor of 110,000, direct materials of 170,000, and fixed factory overhead of 28,000 for 8,000 hours of production. The department actually completed 10,000 hours of production. What is the appropriate total budget for the department, assuming it uses flexible budgeting? This is D. It's okay. It's a lot. There's a lot going on here. So we're going to take our direct labor, which is the 10,000 hours of production times $13.75 per hour. Add in the direct materials, 10,000 times $21.25 per hour, which gives us our total variable cost. Add our total fixed cost of 28,000, and that's going to give us our total budget of 378,000. And they show us here how they calculated that hourly rate. So to get your rate for your direct labor, you're going to take budgeted direct labor of 110,000, divide that by 8,000 hours of production to get the $13.75 per hour. To find your direct materials per hour, you're going to take the direct materials of 170,000, and you're going to divide that by the 8,000 hours of production to get $21.25 per hour. So then you take your hourly rate, multiply that by what they actually completed, and that's going to give you the direct labor completed. If you use the direct labor rate, it'll give you the direct materials completed. If you use the direct material rate, add your direct labor and your direct materials to get your total variable cost, and then add your total fixed cost to get your total budget. Chelsea Manufacturing Company's static budget for 5,000 units of production includes 40,000 for direct labor and 5,000 for variable electric power. The total fixed costs are 23,000. At 8,000 units of production, a flexible budget would show. So we have to solve for this. So we're going to solve it, again, the same way that we did the others. Your direct labor, it's going to be the 8,000 units of production times whatever the per unit amount is. In this case, it's $8. And they do show us down here how they found that. So they took 40,000 for direct labor, because we're looking at direct labor. So they took the 40,000 for direct labor and divided that by the 5,000 units of production to get $8 per unit. So then to find this direct labor, we're going to take 8,000 units of production times $8 per unit, which gives us 64,000. The electric power, we're going to take the 8,000 units of production times $1 per unit, and that's going to give us 8,000. Add those together to get our total variable cost. And then we have our total fixed cost listed here. So our variable cost of 72,000 and our fixed cost of 23,000.